The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Juliana Tattelbaum. These are your headlines. US President Donald Trump pushes back the deadline for tariff talks with the EU, granting the bloc a reprieve from his threat of a 50% levy after a call with Ursula Von Der Leyen.
We had a very nice call and I agreed to move it. I believe June 9th would be, July 9th would be the date. That was the date she requested. Could we move it from June 1st to July 9th? And I agreed to do that. And that she said we will rapidly get together and see if we can work something out.
iPhone suppliers pull back in the Asian session after Trump threatens a 25% tariff on non-US made iPhones, targeting a specific company with tariffs for the first time.
And Chinese automaker BYD slashes prices, offering discounts of up to 35%, sending shares sharply lower in Hong Kong as fears over a global price war intensify.
Happy Monday all. Well, we kick off a brand new trading week and it feels as though we might have a somewhat muted start to the trading week given it's Memorial Day stateside. It's bank holiday here in the UK, but of course a ton of news flow going into the weekend and of course over the weekend. To me, what jumps out is that there's a lot of single name exposure risk now. Apple being targeted by the president. We mentioned in the headlines, first time he's targeted a single company in this administration. Previous administration, it was all about single company exposure risk. So that's come back into the mix this time. And of course, around Europe, we're talking about a lot of European threats now when we've got a delay to a tariff that may kick in, a 50% tariff on European goods.
The escalation in tensions between the U.S. and Europe, certainly notable. And I think President Trump has been telegraphing for several weeks now, really since he came back for his second term, that Europe is right at the center of his attention. And now we've got some news flow to digest. U.S. President Donald Trump has delayed imposing a 50% tariff on imports from the EU until July 9th, following a conversation with European Commission President Ursula Von Der Leyen. The decision came just days after Trump threatened the bloc with a 50% levy from June 1st. That came on Friday. Those who were preparing for a lazy long weekend, the Friday news flow had threatened that. This came amid frustration with the pace of the trade negotiations between the two sides. Speaking to reporters over the weekend, President Trump said he and von der Leyen agreed to speed up the talks.
She just called me, as you know, and she asked for an extension on the June 1st date. And she said she wants to get down to serious negotiation because I've told you specifically, but I told anybody that would listen, they have to do that. And we had a very nice call and I agreed to move it. I believe June 9th would be, July 9th would be the date. That was the date she requested. Could we move it from June 1st to July 9th? And I agreed to do that. And that she said we will rapidly get together and see if we can work something out.
Despite a lack of progress on negotiations, EU officials have urged calm following his call with Jameson Greer on Friday. EU Trade Chief Maros Sefcovic said the trade relationship was unmatched and had to be guided by mutual respect, adding the EU would protect its interests. Meanwhile, Poland's Deputy Economy Minister Michael Baranowski said he hopes Trump's threats will not translate into action. And the German Finance Minister Lars Klingbeil said serious negotiations between the EU and US were required. Well, Sylvia has joined us with more. Sylvia, I wonder whether Trump has done the Europeans somewhat of a favour by focusing the minds now with a time frame. First up, we had a very sharp, aggressive approach to June, now kicked out until July. Will that help bring parties to the table?
Well, certainly it is welcomed by the European officials, the fact they have a little bit more time to negotiate with the United States. The question mark is how much progress will they manage to achieve over this period? In fact, we had two specialists in the show earlier suggesting that it's unlikely that we will see tariffs of 50% as President Trump threatened last week. But ultimately, we don't know what sort of negotiation they will manage to achieve. The Europeans want something. It is unclear what the Americans actually want thus far. That is the message from European officials who continue to be frustrated because they are having these conversations with the Americans, but they still don't get clarity in terms of what they would like to achieve.
Can I just jump in on the percentage point before you get into more of the detail? Because it feels as though the Allies do not want to be left with a 10% tariff. We saw that from the Japanese and their negotiations still, and we've seen it in Europe. 10% is a deal breaker for the Europeans or not?
For some Europeans. And that is the problem, because some Europeans, yes, are against having any sort of reciprocal tariffs. The 10% levy is too much for some European capitals. Others, however, are a little bit more pragmatic and suggest that might be the landing zone. The UK managed to achieve that, so perhaps that's the best that we can hope for. But ultimately, we don't know. We did speak to one economist in the show earlier who actually suggested that the best case scenario for the Europeans is to have that 10% levy. But let's see.
When it comes to how Europe could retaliate if we do see President Trump move ahead with the 50% tariff, I think the big question everybody is asking is, at what stage do they start to begin targeting U.S. tech? What's the sense? What's your sense from talking to EU officials?
It wouldn't be immediate because they already have a lot of other prepared measures in case they need to retaliate. And just in terms of numbers to remind our viewers, the Europeans have suspended duties on 21 billion euros of U.S. imports. And there's a list of 95 billion euros ready on the table. That for the time being doesn't include digital services, but that is indeed part of the conversations in Brussels and could be, let's say, a third step if they need to take more retaliatory measures. They would like to avoid that, of course, but they also keep saying that if they have to, they will go ahead with that.
And let's see where we get to on the food safety standards as well. Sylvia, thank you so much for joining us. Now, let's just push on to what we're hearing from the Fed, because the Minneapolis Fed President Neil Kashkari told CNBC that the Trump administration's tariffs have raised economic uncertainty.
There is a heightened recession risk because I travel around my part of America and I talk to businesses large and small. The most common comment that I get is that they are uncertain about the outlook. So they're nervous about making new investment decisions. Even businesses have said to me, if they knew where the tariffs would ultimately settle, then they could adjust their supply chains around that new environment. All else being equal, they may want lower tariffs, but wherever they settle, they could adjust to that. But right now, there's still so much uncertainty as the negotiations are continuing. A lot of businesses are on hold. And if businesses and consumers are on hold, that introduces downside risk for the economy, potentially even recession risk.
Naturally. I mean, one of the other things that naturally we've been focusing on is what kind of inflationary impact, what kind of jobs market impact these tariffs might have. And yet so far, there hasn't been a huge impact, at least noticeably, in either the jobs or inflation data. Does that give you some kind of sense that maybe those effects may not be coming, or do you have confidence that they will come in coming months?
It's hard to imagine them not coming. So first of all, on the job market front, you're right. The U.S. job market has held remarkably firm. New claims for unemployment insurance have not materially climbed. That's good news. But businesses that I talked to have said they're on hold, and they're actually running scenario plans that if the tariff uncertainty persists for a lot longer, then they might have to start shedding workers. Coming out of the pandemic, it was so hard for businesses to find the workers that they needed. They're very reluctant to let them go because they might not be able to find them again. And so they're moving very slowly. On the prices front, you're also right. We haven't seen yet a big imprint on prices. We also haven't seen any shortages. You know, when I go to the local stores in America, a lot of the goods are sourced from abroad or sourced from Asia. The shelves are still full. So we're not seeing, the American people are not yet feeling the impact. And hopefully there will be quick resolutions to these trade negotiations, and then there will not be a long-lasting effect on the economy overall.
Well, as we face the threat of tariffs still, let's take a look at European futures as we get going this morning. You can see green expected to bounce back onto the charts, but Friday was downbeat as we saw a reversal here in Europe, but also in the United States. And let's get to Thanos Papasavas, who is founder and CIO at ABP Invest. Thank you so much for joining us, Thanos.
Pleasure.
One of your lessons to us before was, look, the unpredictability works both ways, and we saw that on the back of Liberation Day, the market spiking. Now we've got 50% tariff hanging hanging over the Europeans' heads. But there is this phrase that's caught on in markets, and I believe it may have started in the FT, the taco trade, that Trump always chickens out, that there is a potential both-way trade here, to your point. What do you make of the European threat?
I think it is. It goes back to the point that it can go both ways, and he is really trying to play both angles. He gives a very hawkish statement, see what impact that makes. And if it does create and instigate some sort of a change, an accelerated path towards the trade, well, it's helping towards his strategy to get things done a little bit faster. And now that particular threat, we do not believe that it's really going to happen. There's always room for negotiation, and he's a pragmatist.
So what do you do in terms of positioning the markets? Because it feels like it's a restless trade. Yeah. We've had, I saw the ninth rotation in the bond market in recent years. I mean, that is just churn one way or the other. We've seen it on the dollar trade last week. We had a pullback, but recent weeks it's been trying to reclaim a little bit of foothold. Stocks were up, and now suddenly we're back down again. What do you do in terms of positioning?
We believe in sort of focusing on the underlying fundamentals, trying to avoid the interim periods of volatility. We do believe this unpredictability does raise the level of volatility overall, and the uncertainty is going to be with us, whether it's for the next few years or potentially if it stays for a third term, during that term as well. So we are aware of that. And therefore, we're focusing on the underlying fundamentals. The underlying fundamentals have shown a sort of some signs of weakness in the US, whereas in Europe, we are seeing the continuing push for that economic growth, the commitment of the Europe transatlantic, if you like, issues which created the policymakers and Brussels to push through. So that puts Europe, in our view, in a slightly more positive outlook economically. So we're more positive the European economy, positive European equities versus the US. And in terms of the dollar, although we don't believe that the dollar is sort of the whole transformational thing against the dollar and US losing its edge, we don't believe that's the case from a structural point of view, but cyclically we could see the dollar a little bit weaker from here.
So do you think that we have seen the end of US exceptionalism? I mean, it sounds like you are pro-Europe versus the US, but not because you think it's the end of US exceptionalism.
That's exactly right. We don't believe that this is the end of the US exceptionalism, because even if we look at the period since the GFC and also since COVID, really there's only very few areas around the world focused in the US which has managed to get itself together, grow and maintain that competitiveness. So we don't believe that the exceptionalism in the US is over at all. But given where the valuations are and the slightly weaker areas of the fundamentals, we think that there's a relative opportunity in other markets, such as Europe, such as UK, such as China, versus the US. And the one area and the one question we have, and we're going to be discussing tomorrow very much in our monthly scorecard meeting, is emerging markets. Because we've been a little bit cautious on the emerging markets, not negative, but slightly cautious, and we want to see what our view is on that.
What are you going to be bringing to the table tomorrow when you talk about emerging markets?
So
what's up for debate?
It is basically the underlying fundamental stories across the majors which will be driving that, the US economy, the Chinese economy, which are going to be making a key part of that, but also the inflationary expectations on what the Fed may be doing. So our view has been quite hawkish on the Fed, and we need to see whether the Fed is going to deliver the interest rate hikes that we initially expected for this year, or whether we're going to be seeing...
You think the Fed could hike this year?
Yes, we still think that? We have not thrown the towel in yet because of the resilience of the US economy and the risk of a slightly higher inflationary levels. And on that economic front is that if we were to see a U-turn, we've seen the sentiment indicators weakening significantly over the last couple of months on the back of the Liberation Day comments. Now, if, hypothetically, we see a U-turn in terms of sentiment, in terms of the US economy, right, and we start seeing a positive line in towards Q2, Q3 data, and inflationary pressures coming through, why wouldn't the Fed raise interest rates?
There's no doubt that credit costs matter, but when it comes to the emerging market model, one does wonder what Trump is trying to break or re-engineer here, because there was a lot of tweeting over the weekend about the iPhone, and obviously the iPhone front and center now, what it costs, where it should be made. And the reality is that if the iPhone is made in India under the current Trump threats, then there'll be a 25% tariff on it. And one point was made on social media, look, so that means you can make a Samsung, a South Korean phone, in South Korea and get a 10% tariff selling it into the US. Very uneven, right? Incredibly uneven. But it means that Trump, if he goes ahead with it, is trying to break the emerging market model.
And what he is, in our view, again, is going to be areas of conversation and debate. So I would not take that necessarily as a 25%. And even if it is imposed at 25%, we could see some easing of that.
But you get the point, though, don't you?
Yes.
That if he wants to pressure this manufacturing, get it away from places like India or Vietnam, China, and back into the United States or somewhere else that's a developed market, then it really alters the landscape that we've been working with in recent years, the margins we've been depending on for a lot of these companies. I mean, it is complete rewiring of the economic system and the business models of these companies.
It totally is, but at the same time, it also introduce another potential concept of a non-US phone being significantly cheaper than a US phone for the US consumers.
Can I just come back, Thanos, to your view that you think there is a possibility that in Q2, Q3 here, that the Fed hikes interest rates?
Not Q2,
That's
from
when you
September
think,
onwards.
From September onwards, the data could improve. If we see a turnaround in the data, which is, I just want to emphasize, this is such a contrarian view. And if we do see a scenario where the Fed actually hikes interest rates that year, what impact does that have on the broader market? That's got to make you pretty bearish.
So we started, well, not bearish, cautious, but not bearish. And I'll mention for two reasons. So we started talking about that in early January, end December, early January. And the reason why, I explained why we think the Fed may be raising rates. The reason why we would not necessarily be bearish on that is because the Fed would only do that if there were very clear signs of an economic recovery.
Right.
And if we were to see hypothetically that the US fixed income market and bonds selling, sort of rising in terms of yield, it could have an adverse impact in the equity markets, but we don't necessarily expect that. We think that the Fed will contain and anchor inflation expectations. And although the 30-year part of the curve may be impacted more by the trade and the credit and so on, the deficits, the 10 years will remain inflation focused. With the Fed being on top of it, we think that the US 10s will be contained, and therefore, yes, we may see some correction in equity markets, but not that significant, so not sort of doom and gloom.
Well, Thanos, well done looking out until Q4, because I think most market participants can't see their way through the latest quarter. Thanos, thank you very much for joining us. Thanos Papasavas with us, founder and CIO at ABP Invest. The global trade war has US businesses finding a workaround for tariffs, and it's entirely legal. Read the full piece on CNBC.com.
Coming up on the show, French President Emmanuel Macron begins a 6-day visit to Southeast Asia. We'll discuss what he's hoping to achieve in the region. Plus, Trump threatens iPhones made anywhere but the U.S. with tariffs. We'll bring you all the details later this hour. And Tommy Stodlin, the co-founder and general partner at Giant Ventures, will join us to discuss the outlook for European tech as competitiveness takes center stage. Don't miss that conversation coming up at 9:30 BST. Welcome back to Squawk Box here. President Trump has threatened to slap Apple with a 25% tariff on iPhones sold in the U.S. that are manufactured abroad. In a Truth Social post, he said he had told Apple CEO Tim Cook he expects iPhones sold in the U.S. to be manufactured domestically and, quote, not India or anyplace else. Trump later added that the same tariff would apply to other phone makers like Samsung on devices imported into the U.S. Analysts have long doubted whether Apple can shift iPhone production to the U.S. without major price hikes, and those concerns have been renewed by Trump's latest threats. In a note after the announcement, Wedbush's Dan Ives said shifting production to the U.S. would take 5 to 10 years and raise the price of iPhones to at least $3,500. He says the very concept of an iPhone manufactured in America is nothing but a fairy tale. Goldman Sachs, meanwhile, notes the 25% tariff threat is lower than Trump's initial so-called reciprocal tariff proposed on Apple's key assembly hubs, namely China, India, and Vietnam. These are on pause, but are currently set to resume this summer. It also warns the latest move signals the White House may be less open to future smartphone tariff exemptions. And looking at Apple's bottom line, Citi says a 25% levy on all U.S. imports would impact Apple's gross margin by around 130 basis points for the next fiscal year. But in its base case scenario, the bank sees the U.S. instead imposing tariffs of 20% on China and 10% on India, and that Apple would pass on around 1/3 of the incremental cost to consumers and suppliers. No easy feat when it comes to modeling some of these scenarios. Speaking to CNBC on Friday, the Chicago Fed President Austin Goolsbee said the uncertainty around Trump's tariff announcements was making any planning virtually impossible for businesses of all sizes.
The CEO of a construction company said for them, we're now in a put your pencils down moment where they just have to wait if every week or every month or every day there's going to be a new major announcement. They just can't take action until some of those things are resolved. So it's not surprising that's the environment that we have been in, but it does just heighten the amount of, it's more than uncertainty, it's the non-consistency that for bigger decisions, the businesses are saying that they need to have some idea that it's going to be a constant that they can count on when making the investments.
Here's a look at how some of the key iPhone suppliers are trading. We've got a bit of a pullback here as investors try to digest and understand what could be on the horizon in terms of tariffs from the U.S.
Earnings season may be winding down, but all eyes are on Nvidia, with the chip giant set to report numbers after the market close on Wednesday. We'll also get a check on the U.S. consumer with numbers due from a slew of retailers, including Macy's on Wednesday, along with Best Buy and Gap on Thursday. Just circling back to the Nvidia numbers, it feels as though we've heard a lot of Jensen Huang lately anyway, so typically coming up to an earnings outing, it feels like show and tell season. You get the CEO talking, but I feel like we've had him talking a lot recently, so how much more will he volunteer in terms of some of the big threats he's facing right now? Number one, front and center, is the China threat, and today these reports suggest that the H20, that is of course not for sale now, it's not able to be sent into the Chinese market when it was the China chip, so we get rid of the H20. What's coming? A new no-name chip at this point, and that is set to be mass marketed, mass produced, and set for June, as early as June in terms of production. So we're watching that closely, and don't forget when it comes to the price action, still very expensive. $6,500 to $8,000 the price tag. Previously the H20 was selling for roughly about $10,000 to $12,000, so still a fairly mighty chip, but in terms of its performance, it will not be the same strength as the H20. Will this impact the market share that we are seeing from Nvidia in China? It has been talking about that Chinese market being effectively somewhat shut to it. So it was at 13% of its sales type of market this time last year. When it reports what sort of fatigue you're going to see in these numbers thanks to the tariffs and the lack of those H20 sales that had to take a big write-down in terms of inventory, of $5.5 billion inventory write-down is what it took recently.
On Nvidia, Jim Cramer has been extremely vocal about Nvidia all the way up and through the downturn as well. And in terms of his commentary heading into these results, he says Nvidia stock has been in no man's land, but he predicts that the company will discuss its growing software arm during the earnings update this week. The business could explain why the stock has more upside. I think investors are going to be really focused on how Nvidia explains its strategy around navigating these exports to China, given the headwinds and all the uncertainty coming from the Trump administration.
Well, the reality is that there are so many partnerships that Nvidia has inked in recent times, and that is on the hardware and on the software. So it really has a piece of every puzzle linked to the data center and around AI. And what we've seen lately is that, look, a lot of big companies are not pulling back on their AI ambitions. They're trying to fast forward in that direction if they can. So even with all the tariff threat, they're still very much committed to AI. And the question is whether that is still very supportive for the data center. I think for Nvidia, where the problem crops up really is still around the Chinese market. We're seeing the likes of the Huawei, one of the big players in the Chinese market, come up with its own chip, and it has had some success with this. The Ascend chip, how much more market share will that be grabbing in the Chinese market? Don't forget the market share that Nvidia had in China back in 2022 before the tariffs was 95%. So that is thought to have dwindled all the way back to 50%. Still significant, but where do we see that going from here, given all the twists and turns around export curbs?
And Nvidia, I think, as a company, has tried really hard to play both sides here to maintain its commitment to China because of what a huge market it sees it as. And you just heard Jensen Huang a couple of weeks ago saying how China is absolutely a key player, if not the player to beat in the AI race. When we talk about competition, it says China is absolutely a formidable player here. At the same time, he's also trying to appease the Trump administration because they are so vulnerable, and they say they are going to play by the rules, they're going to abide by what export curbs are put in place by the Trump administration. How long, though, can they straddle the line and play both the Chinese and the American market? What's
in the price, though, when you look at some of the chips and how they've traded recently? I mean, clearly they were a trade for 2024, but the reality is with the route that we saw in recent weeks and months, that very much punished the semiconductors. And even before that, I think there were questions around just what sort of valuations we were seeing in the so-called picks and shovels. So is there still a price, and will there be some price discovery when that Nvidia number crosses the tape on Wednesday?
Well, we've got a lot to look forward to on Wednesday. Meanwhile, the EU is reportedly set to scale up its investigation into Shein by detailing grievances and demanding remedies from the fast fashion giant. That's according to Bloomberg, which reported that the move could come this week. If the company fails to comply, the EU could levy fines of at least 4% of annual sales in member states.